Hi, this is Joe Wright. I'm a financial advisor here at Sage Advisors. Today I want to talk to you about the tried and true rules to investing. These are simple steps that if you follow, you're going to have a leg up on the average investor. Okay, rule 1, know your objective. I recently saw a commercial where a guy was walking down the street and sees his neighbor with a number over his head. It said gazillion. And the guy said, "How do you plan for that?" "I don't know, I just throw money at it and hope something good happens." Well, rule number 1, know your objective. Bottom line is, when you're investing, you need to have a goal. Okay? So set a goal, and from that point, we can decide what tool is going to be best to use to get you to the investment goal that you have. So bottom line is, when you're choosing tools that you're going to invest in, think about it as if you're cutting wood and you're making a fine piece of furniture. There are different tools that I could use to actually cut the wood, but there's a perfect tool that I want to do to make a fine stool or something like that. So the same can be said for choosing investment choices, investment accounts. If I'm saving for retirement, or if I'm saving for a house, a car, or a vacation, I need a tool that's going to put me in the best place possible to reach my goal. Okay. Rule number 2 is diversify. The main tools I like to use for diversification are mutual funds, ETFs, or for wealthy individuals, separately managed accounts. Bottom line is, if you're going to own a combination of stocks, bonds, and cash, you should own a lot of stocks, bonds, and cash. And you can achieve this by investing in shares of things that own a lot of those different assets. The next step to diversification is investing in different asset classes. So what I do is I start with the amount of stocks, bonds, and cash that I wish to own, and I dive deeper into that asset class. For instance, in stocks, I start with large cap stocks, mid cap, small cap, international style stocks, so that I own the different parts of that asset class. Same with bonds. I'll start with corporate bonds, treasury bonds, international bonds, and try and diversify among those different asset classes. And then I'll fill in the rest of the portfolio with the amount of cash that's needed for liquidity purposes, and also to act as the bottom riskless asset in the portfolio to draw down the risk of the portfolio. Rule number 3 is invest for the long term. Bottom line is, 1 year time frames of any asset class you look at, there's going to be a volatility or a dispersion between the highest rate of return you can expect and the lowest rate of return. Bottom line is, it's going to be volatile no matter what asset class you're in. When you fast forward and look at more longer time frames, like 5 and 20 year time periods, is you find that there's kind of a squeeze on getting closer to the average rate of return you should expect from investing in that asset class. So what I like to tell clients is that you have to go through those 1 and 5 year periods to get that 20-year average you're looking for. Take a couple who's 65, for instance. Now, many people feel that the investment time horizon is, for most people, is to reach age 65. There's actually a 25% chance that one person in that couple is going to reach the age of 95. So that's still a 30-year time frame. Now, if you're 50 years old and you're far-reaching for that 95 age, that's a lot of 20-year time periods that you have to go through. So invest for the long term, keep a strategy that works, and it will pay dividends over time. Rule number 4 is investing systematically. And what I mean by this is dollar cost averaging. When you're doing this, you're using dollar cost averaging as your market timing device. And what this does is this kind of removes emotion from the ballgame. So over time, what dollar cost averaging has done for you is you've purchased a lot of shares at a lower average cost per share, meaning that as time goes by, the total value of your portfolio is actually greater than what it should have been had you just bought and hold at the start. Okay, and the final rule to investing is review systematically, and I call this rebalance. What rebalancing is you start with an ideal allocation for your portfolio, and it's appropriate for your risk tolerance and your time horizon. So you've allocated your portfolio, let's just say you're X% in bonds, you're X% in international stock. After a 1-year time frame, let's just assume that international stock outperforms bonds, and now it's a greater piece of the pie of your portfolio. What I'm saying with rebalancing is you should sell what's done well and purchase what hasn't done well. Emotionally speaking, this does not feel natural, but what you're doing is you're selling high and you're buying low, and you're putting your pie back to the ideal allocation that's appropriate for you. Next year, let's just assume that if bonds actually perform better relative to the other assets, you would have made the right decision. And doing this on a regular basis smooths out the return of your portfolio, maintains the appropriate risk profile of your account, and you don't take undue risk by letting things just sit. Achieving success in investing is tough for people to do on their own. Here at Sage Advisors, we've got the tools and the expertise to make that happen for you.